Welcome to the Real Estate Espresso podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. On today's show, we're continuing our mini-series on industrial real estate across the U.S. Today, we're moving through the central states, starting around the Great Lakes and moving to the Midwest, Memphis, and finishing in Texas along the Gulf Coast. Marcus and Millichap's second quarter reports reveal a pattern that we've seen in several parts of the country. Industrial is not suffering from one uniform demand problem. In many markets, developers simply built much faster than tenants could absorb the space. Now, construction is slowing, and in several cities, demand is beginning to catch up. Let's start in Chicago. Chicago remains one of the tightest major industrial markets in the country. Vacancy is forecast to reach 6.1% this year, still well below the metro's long-term average. Leasing volume increased about 15% last year, particularly strong large bay demand around Joliet, Bolingbrook, and O'Hare. The first quarter of this year also produced the strongest opening quarter absorption since 2022. But it is a mixed picture. In other parts of the country where small bay has been somewhat the darling of the industry, here in Chicago, small bay tenants have actually been giving back space. Asking rents are expected to decline slightly, around $8.30 a square foot. That is a low rate compared with other markets across the U.S. And about half of the construction pipeline remains uncommitted as of April this year. The positive is that construction is slowing materially. Chicago is not a high-growth Sunbelt story. It's got a huge transportation manufacturing infrastructure with a well-established industrial base, and that can provide resilience when new supply remains disciplined. If you move west to Cleveland, the numbers are even tighter. As of March, Cleveland had the lowest industrial vacancy rate among all the major U.S. markets. Vacancy is expected to finish this year at only 4.6%. Construction is almost non-existent, growing inventory by just 0.2%, the slowest pace since 2013. Small bay properties are especially tight with vacancy below 3%. That is starting to attract private investors towards well-leased older warehouses and manufacturing assets. Cleveland is interesting because this is not a market where the thesis depends on explosive population growth. The thesis is scarcity. When very little gets built and existing functional industrial space remains occupied, owners can benefit from the supply environment that is difficult to replicate. Columbus is a different story. Here, major tenant commitments are driving the recovery. Vacancy declined 180 basis points at the beginning of this year, where large leases from companies like Koch Logistics, Ryder, Illuminate USA, and Meta helped vacancy fall to 2.8%. Anduril is also developing 1.7 million square feet of manufacturing capacity south of the Rickenbacker International Airport. That type of investment matters because manufacturing facilities create secondary demand. Suppliers, logistic companies, maintenance businesses, and service providers often follow the primary employer. Columbus vacancy is forecast to decline to 7%, while asking rents increase more than 6% to a record $7.50 a square foot. Institutional investors have started to notice. Transaction volume above $20 million increased substantially this year, suggesting sophisticated capital is starting to gain confidence in the market. Let's look at Memphis. Memphis has always had extraordinary logistics infrastructure. You've got 5 Class 1 railroads converging there. You've got the Memphis International Airport, the busiest cargo airport in North America, but the story is expanding beyond logistics. Large bay leasing increased more than 60% over the last year, exceeding 20 million square feet. Manufacturing vacancy also declined by more than 200 basis points. Ford's Blue Oval City and the Amplify battery plant are helping broaden Memphis from a pure distribution hub into a manufacturing and logistics hub. At the same time, there's very little new industrial space being built. Combination allows vacancy to fall for the first time in 4 years, reaching about 8.9%. Now, for investors, I would pay particular attention to smaller industrial properties serving these large manufacturing investments. The factory itself gets the headlines. The less glamorous supplier buildings nearby can sometimes offer more durable investment. Now let's look at Texas. You've got Dallas-Fort Worth showing meaningful signs of improvement after several years of heavy construction. Vacancy in South Dallas declined about 450 basis points in the last year, helped largely by commitments from folks like Google leasing 2 warehouses totaling 2 million square feet. First quarter leasing activity nearly doubled from the previous year. At the same time, completions are expected to fall to their lowest level since 2013. That should help the metro vacancy decline to 8.9%, while rents increase to about $9.40 a square foot. We're starting to see private investors returning as well. Transaction activity increased roughly 40% driven heavily by deals between $1 million and $10 million. That tells us the recovery is not limited to institutional capital. And then finally, let's look at Houston. The Houston forecast calls for about 19 million square feet of deliveries this year, employment growth of 0.9%, vacancy around 7.9%, and asking rents reaching about $10.36 a square foot. Now, despite the continued additions of inventory, vacancy growth is expected to slow considerably compared with last year. So what is the broader conclusion? Across these central markets, the most important trend is the slowdown in construction. Cleveland already has scarcity, Chicago remains pretty tight, Columbus is benefiting from manufacturing and technology investment, and Memphis is diversifying beyond freight. Dallas is finally starting to absorb a portion of its absolutely enormous construction pipeline, and the common thread is that industrial demand increasingly follows infrastructure and manufacturing investment. But as always, you still need to distinguish between a growing market and a good investment. The best market can still produce a bad deal if you overpay for it, and a slower growth market can still produce an excellent investment when the supply is constrained, the building is functional, and your basis makes sense. So while there are some common themes, each of these markets are unique, and you definitely want to go out and get copies of the second quarter industrial reports from Marcus and Millichap. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk again tomorrow.